Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you're looking to retire early with forever passive income, you're in the right place. This podcast is the go-to destination for real estate investors, both active and passive, and multifamily apartment investors, both new, intermediate, and advanced. Now, sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
Hey, what's up, guys? It's Josh, and I wanted to just say hi. Happy New Year. I'm excited to be back with all of you guys. And today I want to talk about a deal that we just closed where the lender shorted us $1 million at closing. So the deal is what we call 220 Brookside Shady. It's 220 units. It's a portfolio that we bought. We closed on December 30th, 2021, just a couple weeks ago. And great deal, off market, had a broker that brought it to us. Nobody else knew about it. Nobody else ever saw it. They brought it to us off market, and we were excited for the opportunity. The price that the seller was looking for was about $15 million, and it was off market. So we went to see it. We loved it. It's right in our wheelhouse. It's 50 units in Lakewood, Ohio, and then another 170 units in Cleveland, right by the Cleveland Zoo, which is a pretty solid area. And so the price that they were looking for was about $15 million, 220 units. So that's about high 60s a door, right? And so we agreed. We agreed at a price of $14.85 million with a $200,000 reduction in that price if we could close by the end of the year. So $14.65 million. We went into contract officially on November 20th, 2021. So November 20th, 2021, we're under contract. We're rolling through the due diligence. We've got 30 days of due diligence and basically 40 days to close a $14.65 million deal. If we can close it by the end of the year, it saves us $200,000. If it doesn't close, the price goes up by $200,000. It goes up to $14.85 million. And because it was off market, because we knew we could close it, and because the seller wanted to be confident that we would indeed close the deal, the seller said, hey, we want hard earnest money. So we actually offered $200,000 of hard earnest money as soon as the PSA was executed. So we put up $200,000. That's locked in. Fast forward, we go through the due diligence. We love the property. We love the underwriting. We love the opportunity to increase the rent. We love the area. 50 of the units are in what's called the Gold Coast of Lakewood, which is right on the water. And the rents are $300 below market value easily. Could be $400 below market value if we do a heavy CapEx program. The portfolio was originally built by the dad in the 60s. So the buildings are 60 years old. The dad, the developer, passed away. The kids inherited it, and the kids live all over the country. One I heard is like a judge in California. One is a lawyer in Chicago. None of them live in the greater Cleveland area. So they want to sell it. They want to get out of it. They want to exit the portfolio, and for sure they want to sell it and cash out, and we want to buy it. So we go into it. We make the offer. We agree. We put up $200,000 of earnest money. Then it has an original closing date of the end of the year. So if we close by December 31st, we can close and we can save $200,000. But if we need an extension, not only does the price go up $200,000, but we got to put up another $50,000 of earnest money. So we're going through due diligence. Everything's checking out. We're getting our lender quotes in early December. We get a quote from a lender, and the property, because the rents are so low, it doesn't qualify for permanent financing, even though the building's super stabilized, 97% occupancy. the debt service coverage ratio is too low for us to get permanent financing. So we look at bank financing, we look at bridge financing. At the end of the day, it made the most sense in the capital stack to get bridge financing because the bridge lender was going to give us the highest loan to cost. They were going to give us the most money at about 5% interest. And then we had to raise about $5 million in private money. So I did the raise right after Thanksgiving, raised all $5 million, actually got $7.5 million in commitments. We worked with those investors. We finalized the money. We got all the money in the house before Christmas. So within 2.5 weeks, 3 weeks, we had all the investor money in-house, ready to close. So we're sitting on the money. It's ready to roll. And we're told that the appraisal is supposed to come in right before Christmas. Okay. So we're like, okay, right before Christmas, no big deal. Everybody goes on Christmas break. The Monday after Christmas, no appraisal. Now it's December 27th. We're supposed to close on the 30th. No appraisal on 27th. No appraisal on 28th. Appraisal finally comes in on the 29th. And the current as is value, it appraises. Awesome. The appraiser, however, takes all of our projected rents and our CapEx budget. We have an almost $1.8 million CapEx budget to improve the building, raise the rent. And our pro forma is 4 years from now. Okay, 4 years from now, we're looking to increase the rents by about $350 a unit. With a heavy CapEx plan in 4 years of time, this is indisputable. We should be able to absolutely get these rents. There's other comps that are getting these rents today, including some of my own buildings that I own in this area that we're already getting, like on a 2-bed, 1-bath, 800 square foot. We're already getting $1,200 in rent today. 2-bed, 1-bath, fully improved, big CapEx program. We're getting $1,200 a month in rent now. But the appraiser decides to short the rent by $100 a unit. And because of that, the future stabilized value that the appraiser marks on the appraisal, it ends up coming in, meaning that we're going to be short $933,000 at the closing table. Now, mind you, this is December 29th. We're supposed to close on the 30th. The title companies, the banks are closed on December 31st. So we get the news at 9:16 in the morning on Wednesday, December 29th, that we're going to be short $933,000 at the closing table. Okay, no problem. So instead of having to bring roughly $3.8 million to closing, we've got to bring $4.8 million to closing. And looking around, I'm like, okay, what are we going to do? Okay. And, Pete Carroll, the head coach of the Seattle Seahawks, is famous for a quote. And that quote is, so what? Now what? So what? Now what? Okay. And so you get information, you learn something happens. And in football, it could be that somebody gets injured, somebody gets COVID, somebody can't play, somebody gets traded. So what? Now what? And so I thought to myself about that quote. So what? Now what? So what that we're short $1 million at closing, and we've got to close essentially tomorrow before the end of the year. Because remember, if we close by the end of the year, it saves us $200,000 on the price, right? Also, the broker that brought us the deal it wants us to try to close if we can. We could certainly extend. We already put up another $50,000 to extend the closing if we needed it. Okay, if we needed it. And so what? Now what? So I call my team. I bring them all in. We get on the phone with the lender. Everybody's looking around. It's $1 million short. It's 9:16 in the morning. By the time that call wraps up at around 9:30, I tell our broker who's brokering the loan. I said, dude, look, it's no problem. I'll wire in an extra $1 million and we'll get it closed. We're going to close tomorrow. And he's like, dude, I'm sorry. Like, I can't believe this. The appraiser was supposed to send this in last week. Normally, here's how it goes. Normally, if an appraisal comes in short, it's usually for two reasons. Either the real estate taxes are high or the rents are short. That's why appraisals come in low. So the taxes were spot on. The taxes that he assumed were exactly the taxes that we assumed, but he shorted us $100 on the rent. Well, that's a lot of money. $100 per month times 220 units. It's $22,000 a month. Okay. And it's $250,000 a year at a 6 cap. Yeah, it's worth $2 million. And so we're short $1 million of funding at the closing. The lender is going to fund all of the CapEx, the full 1.8 million, but that's done on a draw. That's still there for us to draw against, but we're short the $1 million at the closing table. So what do you do? Right?
In my newest real estate investing book, The Flip System, you'll learn the proven secrets and strategies that I've used to be a successful real estate investor. You'll also hear the story of my journey from quitting my job to doing over 2,000 units of apartments. The Flip System is now available for a limited time, and you can grab your free copy at getflipsystem.com/podcast. You'll learn the same proven principles and secrets and investing strategies that I used to quit my job and pursue a life of financial freedom. In this book, I'm sharing exactly how I was able to personally close over 750 profitable real estate deals, make over 400 private lender loans, raise over $30 million, and acquire over 2,000 units of cash flowing apartments. Get my newest book now for free at getflipsystem.com/podcast. That's getflipsystem.com/podcast.
So what we ended up doing is, we had overraised for this deal because we needed operating capital. We were also going to take an acquisition fee of about $300,000. So we had overraised, just so happens we had overraised by $700,000 to cover the acquisition fee, to cover the operating capital, to cover some of the cash bleed. Remember, the rents are super low. The debt service coverage ratio was low. So we knew it was going to cash bleed. So I tell our CFO, hey, Roberto, go ahead and wire $550,000 to the closing table. And he does. And then I find out, okay, well, we're $933,000 short. So we're gonna source the other $300,000, which we did through some different accounts of mine and our company, and we funded the other $300,000. And so, we've got all that money in house now. It's ready to close. The next day, we go through our final closing checklist with our lender, our attorney, their attorney. We get everything done, everything in. There's a couple forms that have to be signed and turned in. Our property manager has to sign a form. I have to sign a form, send them in. Some of them have to be originals. So we got to sign them. We got to notarize them. We got to drive them to the title company. This is on December 30th, Thursday. I'm recording this a week later. I'm recording this on January 7th. So this just happened 8 days ago. It seems like forever ago already, but this just happened 8 days ago. And sure enough, we close. We get notice from the title company at around noon on the 30th that she sends us an email and says, hey, I'm effectively considering this deal closed before the end of the year. We've got to wire out all the money and we're done and we're ready to go. And so we get the notice that the deal closed, even when the lender shorted us $1 million. Now, what normally would happen when an appraisal comes in short, I didn't cover this. Normally what would happen is you'd have maybe a week or so. You would go back to the appraiser. You would reprove your comps. You would go back and show them what the comps are. Literally, there's buildings renting right now for the same rent that we were projecting 4 years from now. So why this guy thought he would short us $100 a unit is beyond me. because there's other buildings getting the rent today that we're projecting we're going to get 4 years from now. So I thought it was pretty conservative. We bought it for $14.65 million, and we're projecting that the future value is around $24 million after the CapEx program and after we bump the rents and after 4 years of inflation. I mean, we're going to get these rents. I've got other buildings in these markets. I'm getting these rents today, right now. I've got a comp at, we call it 52 Lake, with a building that we own. It's called Clifton Lakes Apartments. You can look it up on Google. Go ahead, check it out. You can find the listing on apartments.com. You can see the work that we do. You can see the units that we're turning. You can see the commons. It looks amazing. You can also look up Forest Ridge Apartments. You can look it up on apartments.com. Forest Ridge Apartments in Parma, Ohio. You can look up on, again, apartments.com. You can see the work that we're doing. These units look amazing. Granite, LVP, white shaker cabinets, black matted hardware, stainless steel appliances, all new bathrooms. Tubs are glazed, tub surrounds. The tile is glazed, new toilets, new vanities, new mirrors. It looks amazing. I know we're going to get these rents, but this appraiser, for God knows why, decided to short not the as-is appraisal, but the future stabilized appraisal. And the lender shorts us $1 million. We get it closed anyway. So now I've got a little bit of work to do because I need to backfill that $1 million. I'm going to raise that $1 million. Matter of fact, today I got a commitment for $500,000 to come in and fund that half of that difference. And so here's the end result of what actually is going to happen is the $933,000 that we were shorted, instead of getting that at bank financing at 5%, we're going to raise half of it in equity. And that $500,000 of equity, we're going to pay a 10% preferred return, plus give up 2.5% equity in the building. Okay, so we lose 2.5% equity. Big deal. Okay, we got to retain. This isn't a normal syndication where the GPs get 30% and the LPs get 70%. In this syndication, we kept 77%, and the LPs got 22.5%. So now we back down. We're still keeping 75% of the equity, and the LPs are getting 25% of the equity now. So we're good. Like, it's no skin off my back. Okay, we're good. And then the other $500,000 is essentially the money that we just needed to fund the CapEx so that we could then go to our lender and do a draw against the $1.85 million construction budget. You following me? So that we're actually going to raise in the form of debt. We're going to raise that from some private investors, have them lend the money to us instead of doing equity, do debt, lend it to us so that we have the capital that we can then use it, do the construction, do $500,000 worth of work, and then go request a draw from the bridge lender. You see what I'm saying? So instead of giving up more equity, we're just going to do a line of credit, do the work, and then go nick the bridge and pull that money back into the deal. So what are the lessons that you can learn from this, right? Real world case study just happened 8 days ago. First of all, always overraise. Number one, always overraise for your deals, because people will flake out. Private lenders will, not be able to fund on time. I would rather overraise and give up a little bit more equity than underraise and be short. That's number one. Number two, look, when you've got an opportunity to close. Okay. Find a way, come hell or high water, find a way to beg, borrow, don't steal. People, that old, that old statement, beg, borrow, and steal. Beg, borrow, but don't steal. Okay. Because the amount of credibility, number two, the amount of credibility that we were able to get from our broker lender and from the broker that brought us the deal, the real estate agent that brought us the deal, some of the words that they used when we closed. So my broker's like, dude, you're an animal. Okay. Broker says, oh my God, the growth that you guys are having is legendary. Okay. Remember last year, we bought almost 1,400 units of apartments just last year in 2021 in the middle of a pandemic. Okay. 1,400 units. Okay. It's pretty amazing. And So that the amount of credibility now that we've earned from the lender, the broker, our investors. Imagine if this deal didn't close. I mean, oh my God, it would have just been like, if we didn't close, we'd not only have lost $250,000 of hard earnest money, but if we also didn't close, like it just doesn't look good, right? Not only did we close, but we closed in 40 days after we got shorted $1 million. We got a $200,000 reduction in the purchase price, and we had $250,000 hard that we would have lost. So we check all the boxes, we get it closed. So one is, look, always overraise for your deal. Number two, when you can close early. Number three, look at the credibility that we were able to get by closing early. Okay. Number four, beg, borrow, don't steal. Right? If I had gone back to my investors, I bet you if I would have made half a dozen phone calls, I could have raised another $1 million because of the relationship. So number five, the relationships that you build with private investors become personal relationships. Personal relationships is where it's at, because those personal relationships is what's going to allow you that when you get in a situation like this, I wouldn't even call it a bind. For a lot of people, it would have been a bind. But for us, like, we're scaled up and ready for this kind of crap, right? So, but if I'd gotten in a bind, if I had made a half a dozen phone calls, I'm sure those guys would have wired it a couple $100,000 each. We would have been able to close. That only comes with creating personal relationships. Okay. Gary Vaynerchuk talks about in a lot of his videos about, scale only happens by having people know and care about their job, people that want to put in the extra time and effort, and people buying into the culture of your ecosystem or your company. It doesn't happen by like people playing foosball or ping pong during lunch. It doesn't happen because of the freaking snacks in the, in the company lunchroom. Culture happens by building personal relationships with people. So when I think about building personal relationships with investors, those investors, I learn about them. I learn about their kids. I learn what's important to them. Why are they investing with us? Tell me about your family. Tell me about your spouse. Tell me about your kids, your grandkids. Like, what are you going to use the money for? So that when I get caught in a bind, if it was, in this case, a lot of people would have been a bind. For us, no big deal. Like, we were ready. But if I ever get in a bind, then I'm sure I will at some point. It's those personal relationships where people will have confidence. They'll have confidence in you. They'll have confidence in your deal. They'll want to help you out. They'll want to pitch in. Okay. Because you asked questions, you cared, you gave a shit about their kids, their grandkids. Why are they investing? What's in it for them? Right. That's why people invest with you or with me, is because the personal relationships. And that's ultimately what it's about. Okay. I didn't need to make the half a dozen phone calls and raise the extra $1 million at closing. Okay. But now that closing's over, I've got some time. I've got a couple weeks. I can go backfill that $1 million. I already got a $500,000 of it today. And it's not because I'm special. It's not because, I'm super talented. It's because I invested in the relationship. Okay. It's because I care about people. I want to learn what they're doing. Like, what's their golf score? What did they do for Christmas? How are their kids doing? I've got one of our investors whose son's fighting cancer. How's he doing? How's he holding up? What's the latest on his prognosis? That's what matters. So if you're looking to I want to invest and I want to own 10,000 units because I want to make a lot of money, I would submit to you that you'll own 10,000 units if you invest in relationships with people. I've got guys investing now that are into us for over $1 million, $1.5 million that started with $100,000 5 years ago. Okay. Because of the personal relationship. Think about it. Invest in it. Invest for the long term, not for today, not for the next deal, but for the next 5, 10, 15 years. In 5, 10, 15 years, you'll wake up You'll be wealthy. You'll be full of relationships. You'll be full of happiness. You'll be doing it the right way. And if you're short $1 million at closing, you'll have people stepping up to fund it for you.
Hey, Josh here, and do you want to win a free Accelerated Investor t-shirt? All you have to do is give Accelerated Investor, our podcast, Accelerated Investor, a rating and a review on iTunes, okay? Do that now. Then send us a screenshot on Facebook or Instagram or Twitter. What we're gonna do then is every week we're gonna pick our favorite rating and review, and we're gonna send that person a free t-shirt and maybe, again, some other cool, fun stuff as well from Accelerated Investors. So, again, don't forget to take a screenshot. Leave a rating, review, take a screenshot, send it to us so we know exactly who you are. And then once a week, every week on the podcast, we will announce a new winner. Don't forget to take a screenshot and send it to us so we know exactly who you are. We'll announce a new winner every week.
You were just listening to the Accelerated Investor Podcast with Josh Cantwell. If you enjoyed this episode and learned something new, help us build the AI community by leaving a review and 5-star rating on our iTunes podcast channel. Also, don't forget to subscribe so you never miss another episode. To see passive investing opportunities, visit freelandventures.com/passive. To start your journey toward the lifestyle you've always dreamed of with multifamily apartments, apply for one-on-one coaching with Josh at www.joshcantwellcoaching.com.